In 2000, Enron shares traded at $90 each. By late the following year, they were worth less than $1. Staff had their pensions tied up in that stock. Most investors never got their money back. I'm Bob. I'm retired. I'm not your accountant. And none of this is advice. It's just how the machine breaks. And here's the part nobody tells you. The accounting that killed Enron was legal, approved, signed off in advance. On the 2nd of December 2001, Enron filed for bankruptcy protection. It had been America's darling. Not a bank robbery, no stolen money, no forged checks, just a choice about which rule to use. The auditors didn't miss it either. They were in the building. They saw the lot. To understand how a company dies like this, you need one idea. It's called mark-to-market. Normally, a company books revenue when the money actually turns up. You do the work, you get paid, you record it. Mark-to-market lets you book it the day you sign, not what you earned, what you expect to earn. The regulator allowed it. It was designed for traders holding assets whose price genuinely moves every day. Quick word from the people paying for this: ACE trading bots, automated trading strategies you switch on yourself. It's software you control, not advice. It doesn't tell you what to buy. They're words, and they're the right words. And every trade it fires is a taxable event somebody has to reconcile. Thousands of them. Thanks for that. Right. Enron signed a 20-year contract and booked 2 decades of predicted profit into that year's accounts. The profit was a forecast. On the page, it looked identical to money in the bank. That's the whole trick. So what happens the following year, when the actual money comes in lower than the forecast you already spent? Nothing good. You've already told the market that profit exists. You cannot report it twice, and you cannot unreport it. So you need a new contract, bigger than the last, to book fresh predicted profit and cover the gap. That's not a business, that's a treadmill, and it only speeds up. By 2000, the gap between predicted profit and real cash had become the company's biggest problem. The debt had to go somewhere it wouldn't be seen, so they built somewhere. Enron created separate companies off its own balance sheet and moved the debt into them. The man running them was Enron's own chief financial officer, Andrew Fastow, paid by the vehicles sitting opposite Enron. Read that again. The company was negotiating against entities controlled by the man signing for the company. Every public company has an auditor. Their entire job is to tell shareholders the numbers are true. Enron's was Arthur Andersen, one of the 5 largest accounting firms on earth. They were also selling Enron consulting work, lucrative consulting work, to the client they were meant to be checking. You cannot audit a client hard when that client pays your other department far more than the audit fee. On the 15th of June 2002, Arthur Andersen was found guilty of shredding evidence. It lost its license to audit public companies. That is the end of an accounting firm. Nothing survives that. By the time the conviction was overturned in 2005, Anderson was down to about 200 people. Overturned, 3 years too late, for a firm that no longer existed. Jeffrey Skilling, the chief executive, was sentenced to more than 24 years. He served 12. Kenneth Lay, the chairman, faced more than 45 years. He died before he could be sentenced. Andrew Fastow, the man who built the entities, pleaded guilty, got 6 years, and was out by 2011. Now hold those numbers against the people whose pensions were in the stock. In 2002, Congress passed the Sarbanes-Oxley Act, and it changed the job permanently. Executives now personally certify the accounts. Sign a false one, and it's your name, not the company's. Auditors were restricted from selling consulting to the clients they audit, the conflict that ate Anderson. And a new board was created just to audit the auditors, somebody watching the people who watch. Here's the honest bit, and it's the part that should worry you. Mark-to-market was not a loophole. It was a legitimate rule, correctly applied, to entirely the wrong kind of business. The fraud wasn't inventing a number. It was choosing a rule that let an honest-looking number mean something false. That's harder to catch than lying. A lie has a wrong figure in it. This one had none. 85,000 people worked at Arthur Andersen worldwide. A handful of them shredded paper. I knew people there, good auditors. They did nothing wrong, and it made no difference at all. The dangerous number is never the one that looks wrong. It's the one that looks completely fine.